Manish, thank you for joining us today.
It's a pleasure to be here, Abhinav. It's been a pleasure to get to know you. And as you know, I'm jealous of your next couple of years. So it's good to get to spend some time with you before you go off to business school.
Thank you so much. We'll definitely talk about that. I think fundamentally you're in the business of trust, people, and relationships. And private equity is also a lot about numbers and return on equity and so many other things. We'd love to understand from your perspective, how do the soft and hard elements of PE really go together? How do you think about that? What comes first? What really matters?
This is a very, it's a very deep question to start off the interview with when we're still sipping our cups of coffee in the morning. But it's a very astute question, because the trust and the softer aspects of investing and the actual numbers and the performance and the value addition are literally two sides of a coin. And one couldn't be there without the other.
Yeah.
So let me say a bit more. At least for us, or any other firm, when you first start off your journey, there has to be some degree of background about reputation, some degree of trust, getting back to your work, for people to trust you and give you money to manage. Whether you're a VC or a private equity, early or late stage, it doesn't matter. But they also need to see your track record. So you should have been an investor before. It's very difficult for people. It's tough enough to start off your own firm via a spin out or after you work somewhere else. But if you start off your own firm without any investing experience, good luck, right?
Yeah.
So even at the very beginning, I would say the more important thing is the trust, and they also look at your track record.
Yeah.
Right? Then as you start investing, it's your track record which exists. So no matter how much faith and trust and goodwill you have, if your performance is not something to write home about, future fundraisers will be. So essentially, your trust is what lets you perform. But your performance in itself is measurable, quantifiable, and people benchmark what prizes you enter, what value you add, how you exit, what your DPI is, what your MOIC is, what your IRR is, to raise your. So in a sense, when the going is good trust leads to good performance, which then becomes a virtuous cycle. And then good performance enhances your trust and reputation, which then enhances your ability to raise a larger and larger fund. And hopefully the cycle is complete.
But it's sort of like a catch-22 situation. How do you build that trust? How can entrepreneurs do that? How can people who are wanting to start a PE fund without any prior experience, build that kind of trust?
I think when you're in a new market, you've got to see on what the alternatives of your investor is, right? So today in India, what I'm saying is 20 years ago, you may have been able to set up a fund without any investment experience at all. I would say today, it's impossible or close to impossible. You would have needed to have had some experience, be it another larger existing private equity shop where you have spin-offs. The firms become too large, you don't think there's a future for you, or it's going in a certain way, you want another direction, or you're working for a large sovereign, as I was, or a large pension plan, a large client, and you say, I've honed my skills. And for some reason, it could be wealth creation, but typically there should be a bigger aim than just wealth creation, where you have the passion and the persistence to start something off. So I think then you can only do it, then you have a couple of screens. One of the screens is, I think if there is a screen which is called not just trust, but reputation, if that reputation is scarred, no matter how good your track record is, you'll never raise money.
Wow. That totally makes sense. And on the trust point, I want to build a lot more on that. I think you're also able to build trust and succeed in any career if you have the right mentors. And you've been mentored by Rahul Bajaj, you've been mentored by Ho Ching. We were talking about that and how she taught you how to be the quiet guy in the room, how to always speak, in the end, how to listen, how to talk, and so many other such soft elements. Can you talk a bit about your journey with these mentors and what were the insights that you learned from all of them?
I think before we get to Mr. Bajaj or HC, as I call Ho Cheng, I think the formative of years of my life were truly at my first job, my first full-time job. My summer jobs was at Goldman Sachs and at the World Bank, but my first full-time job was at McKinsey and Company. And I spent time with the consulting firm in New York, in Cleveland, in London, and in Bombay.
Correct.
And for us to see my formative years, no matter what you do later on in life, it's always an extension of the skill sets, but also the values, culture, and the type of thinking that grows. And I was very fortunate to start my career, I'm speaking for myself at McKinsey, across a variety of offices. And and the other thing is I had so many mentors that, you were spoiled for choice. But if I was to pick out a couple of names before I met Mr. Bajaj or Ho Cheng, the two names which come up, Tinu Puri was the guy who set up the office in India. He was the one, this was 92, 93. I was finishing business school. He had reached out. I could have stayed on in McKinsey in New York. I could have stayed on in Goldman Sachs. I had an offer from there after spending the summer. But we made the plunge to come to McKinsey India.
Yeah.
Tinu was played a critical role in that. Maybe he wasn't fully honest, to be frank, but that's what mentors are supposed to do. But no, I think the point at that time, for me to get back to India was exciting. It was also a little worrying because most people around you said, you've got an MBA from one of the best institutes in the world. Why are you going back to India? Make your life in the US.
Yeah.
People have paid millions to come across the ship and settle down in the US.
This is right after 91.
This was, so 91 was the big reforms. The office opened 92, 93. So it was still a fledgling office when I started speaking to Tino. And probably at that time, he really wanted people. Maybe today he wouldn't want me, I don't know. But in 95, we started talking in the summer of 94.
Yeah.
I graduated then. I saw him in the summer between the 2 years of business school. After graduation, moved right back. But I would say it was Tino, and then the others that I got to know when I moved to India. One of the people I worked with a lot was Pramat Sinha, who then went on to found as a founding dean of the ISB, was critical in setting up Ashoka University with Ashish Dhawan and Bichchandani. So, but both these individuals, and many more, there was Ranjit Pandit, there was guys who I worked with overseas like Andres Barrotzos, Gary Pinkers. The list is very large, but the McKinsey teachings were all about getting the analytics right. You were younger at that time. You were an associate moving to a manager. It was the first basis of you don't have a voice until you have the facts and a point of view. So what you learned very early at McKinsey was to develop a point of view. It was called hypothesis driven. So it's not that you spend 3 months in a room coming up with an answer. You come up with a hypothesis. Then you do the critical analysis. We call it 80-20 to prove or disprove the analysis.
Sure.
So getting to the answer first is something, if you talk to my wife, I'm like, I don't want this, give me the answer and then give me the supporting, right? So that becomes a way of life, good or bad, right? It also taught you how to work in teams, how do you motivate people. The McKinsey system is very strong on feedbacks. So we had a feedback after every engagement, a feedback every 6 months, a formal review. You put up for partner, you get too many reviews. So to me, in McKinsey, and I primarily point out to a Tinu and a Pramat in that order as being a true mentors to me and teaching me the basis of life. How do you actually analyze stuff? When I moved to Temasek, Ho Cheng is probably the most, I've mentioned this earlier, is the most unique individual who manages to combine true strategic smarts that a McKinsey partner with pure execution, efficiency, with no emotion, as you would the best banker from a Goldman Sachs or a Morgan Stanley. And she did that in a very humble way. She was impeccable in terms of sharing information with the teams. And she would give you a very long rope till you almost drowned, right? And I think that I would say was the most important lessons that I learned in my professional career.
Despite being who she was, which is the prime minister's wife.
So despite being who she was, the ability, what I learned from her was humility. Was humility. A bunch of us, you'd see, if you see our industry in private equity, we are at least told we're a bunch of cocky guys. We're a bunch of arrogant guys. But trust me, if you can, because that was especially the case 10 or 15 years ago when there were very few sources of foreign capital in India.
Yeah.
So even the promoters would know how to handle you and make you feel good. So you start believing that it's the individual when it's actually the institution. You start believing you're the smartest guy in the room and it's actually the access to capital that you should be a proxy for.
Wow.
And, so it's a very deep understanding on separating your own role from what provides the value. It has to be you, but it's not only you.
Yeah.
So what one learned from her is humility to really sort of be in the position of a promoter, understand the issues. And also don't be the first one to shoot your mouth off in a meeting. Sit at the back. In fact, it's okay to be seen by the promoter as the dumb guy in the room. They'll open up more.
Okay.
They'll say a lot more to you. You behave more like the general guy in the room. So there's this whole concept of humility. How do you handle promoters, but also your own people?
Yeah.
How do you be fair to them? And then I would say the biggest impact as a mentor was probably Mr. Bajaj, who can be at the same time, and it's weird, your fiercest critic, but also your strongest supporter, right? So this was a man who would come to our AGMs at Kedaara and say, why are you giving money to this guy? Whereas he really had belief and trust. He was the one who gave, in a sense, he along with 6-7 other families were the first LPs that we had before we reached out to institutional LPs. But more importantly, even before we started Kedaara, he used to keep challenging me. He said, why are you still working at a job? Why are you still a salary man at Temasek? Whereas one used to think, I have such a nice position at Temasek. He also pushes, what are you going to be doing 10 years from now?
Sure.
Do you sure you want to be earning a salary, or don't you want to do something? Don't you want to build a business? And that was said, no, I would much rather be where I am.
Yeah.
But when the kira comes to your head and you see an opportunity and you want to jump on it, the inputs given, the advice given were phenomenal. But I think his inputs, even though initially were of a challenging nature, was all to do with values and culture. It was all to do with, at the end of the day, he says you can lie to anybody else, you can't lie to yourself.
Yeah.
Right? So make sure what you're doing at all times, you're intellectually honest.
Yeah.
You're intellectually honest and you share and manage perceptions. So if I was to just put this in a summary, sorry, I've gone on for much longer than I thought for your question. But when you talk about mentors, it's very moving because these are guys who formed your life. And often you wonder which direction your life would have taken if you hadn't met one of these 3, 4, or 10 individuals. So just to summarize, I think Tino and Pramath were critical in forming the foundations, pushing me to be analytical, to be fact-based, to come up with hypotheses. That is the ethos of the person you've then become. I didn't realize at that time it would be the most powerful things to be as an investor is to have a point of view before you enter the room. And also be open-minded to change it based on what you see. The second, I think, under Ho Ching, playing in a team and humility. And actually, the more power or capital you possess, the more humble you should be, right? Huge expectations on those. So I think with Ho Ching, it was, as I mentioned, a person who taught you humility by her own actions, that despite the stature that she had, she would be in a room working with us, solving problems, would travel and probably do more meetings than any of us would do, whether it was in Bombay, New York. There was no special treatment, right? In fact, we had to make sure we didn't tell the embassy in Mumbai when she was visiting, because then there would be a whole bunch of protocol which we didn't need. But then I would say the last one was Mr. Bajaj, was not the fiercest critic, but he always challenged you. He challenged you in everything you did, right or wrong, whether you agreed or not. And from that, it was honesty. And to be true to yourself and to be true to your partners, right? So analytics as the base, humility with Ho Ching, and with Mr. Bajaj, a degree of honesty.
Now, that's a wonderful summary. And what I like most about this very detailed thought is how thoughtful and reflective you've been on the journey that your mentors have, given you access to or made easier. And, humility and intellectual honesty are, of course, two traits that just make a lot of sense, right? And something to aspire for. And of course, all of that is necessary. But on the other hand, the analytical side, which is also something you developed, is critical. I think going off of the humility and intellectual honesty track, one of the things that I've been curious about is how much capital and PE are different at different stages of the company. I want to also talk a bit about capital and PE in particular. You're not in the business of 0 to 1, but rather 1 to 3. And I think that's a very different skill set from what typically people talk about of building businesses from, 0 to 1. And I'm curious about that because VC and PE have a distinction. And I'm curious about the skill sets, the mindsets, and really what it takes to be an incredible PE investor, an incredible 1 to 3 builder, and not a 0 to 1 builder.
Eventually, the difference, firstly, it's two very different businesses.
Yeah.
There'll be very few early stage venture capitalists who will make excellent private equity guys. There'll be even fewer late stage private equity guys who should make excellent venture capitalists and early stage venture capital. What is it's eventually a risk reward trade off, right? What you do in venture capital is you're betting on ideas when often there is no or very little EBITDA, there may be even very little revenue. Depending on how early. If you're coming in as an angel, it's normally just an idea. If you're coming in as a series 2, 3, or 4 as a venture capitalist, you have a fledgling company, most probably it won't be making a profit.
Yeah.
When you're going in as private equity as a difference, it's a well-established companies. You probably have very strong revenue. You may or may not have a lot of profits.
Yeah.
And that's wherein lies the opportunity for a late stage investor. By the basis of this business, I'll give you something. When you're going as a venture capitalist, if you're making, firstly for the same size fund, let's say it's 100 units of capital, you'll take smaller bets relative to the size of fund, but you'll have many more investments.
Yeah.
So it'll be common for the 100 units of capital, you might have 50 companies that you invest or deploy capital behind. I mean, someone like a Sequoia India, Peak 15 India, I don't know, but I'll be shocked if they had less than 200 portfolio companies. If we were to have 200 portfolio companies, given our level of involvement in each company, we would go bananas. I think we're going bananas with 30 or 20, right? So in venture capital, you essentially invest in 50 or 60 companies. You expect your business model is, I don't know whether it's half of them, 60% of them will go belly up. And 4 or 5 out of the 60 will return the entire fund.
Correct.
So it would be normal to have a 10 to 15x in a few companies and then have a 0 in many of the others. In our industry, in private equity, while it may happen, but we will never have hopefully we'll never have a 0.
Yeah.
It'll also, just to be sure that we remain frank on the other side, there'll be none or very few where you'll get a 10 or 15x.
Yeah.
If you get a 10 or 15x, you've been phenomenally lucky, you've hit the timing just right. In our entire portfolio, and we've done relatively well compared to the competition, we may soon have one company which will be a 10x.
Yeah.
But the average return you're expecting is a 3 or a 4. So you'll think of Jeffrey Boycott, hitting a century doing onesies and twosies, versus somebody else who has a series of 4s and 6s, but often gets out for a duck. So that's the analogy that I would use. It's also a very different skill set. As a venture capitalist, you're investing at a time like an AI today, or a consumer finance, where you are investing at a time where you see either the environment or the competitive situation changing. In our situation, you are taking a good company or an average company and driving performance improvement. So the
Got it.
one in the VC case, you might have got the context wrong completely, and every bet in a sector would go to zero, or you may get 100,
Yeah.
as many would in the AI space today if you've come in early enough. For us, we would never take that bet. That's not an. Eventually, we're a proxy, we're a guardian of our LP's wealth. We don't have that skill set. We are there to make a well performing company much better. Some people do turnarounds. We don't even do turnarounds.
Yeah.
But it's critical to understand what you don't do. It's critical to understand what you know well,
Yeah.
and then focus on that. But I think the common thing between both these things, whether it's VC or private equity, you have to be able to read people. Reading people is what you do every day and every night.
What do you mean by reading people?
So reading people, what do I mean? You may have the very best company. What do you look at typically? How's the macro?
Yeah.
No matter what happens right now, you may not be willing to invest in Pakistan as
Sure.
an example, given the macro depreciation, inflation, etc. Then you say, okay, how is the sector or the subsector? How competitive is it? Are there lots of competitors? Are there not enough competitors? Is the supply chain concentrated? Do you have a concentrated customer? We don't like customer concentration. We don't, we like.
Yeah.
Then you say, how's the company doing relative to the context of the company? Then you get to people, right? Is the company well run? So for us, even if you had a terrific macro, a terrific sector, like telecom today, 2 players, what a great time to be. Much better than when I'm 70. That's how does the industry and sector play? And then the company, let's just say it's doing really well. But if we have even the slightest question mark on the ethics,
Okay.
governance, I'm not saying ESG, DI, I'm saying actual ethics governance, you start doubting the promoter on the smallest of issues.
Wow.
You walk away. We have spent 6 months in one particular, very early in our stage, with lots of pressure to deploy capital. We spent 6 months on a certain company. At the very end of 6 months, he threw a bit of a spanner. Nothing wrong. But he said, hey, that division I want to keep for my daughter. Right?
Okay.
Or something else like that. We walked away from the deal. Because for us, it was going back on something that we had been clear about and had promised us. So even though that particular incident may not have broken the deal, we said then, how do we trust this guy in the future? Likewise, it should be true on our side too.
Yeah.
We should be very clear to all our promoters and our LPs and be very honest what we can deliver and what we can't deliver.
Yeah.
We'll never say we're going to give you a 40% return. We did manage to get a 40% return in Fund 1. But that's because we were partly lucky, we worked really hard. But I can't guarantee that forever.
Yeah.
So all I'm saying is, just like we expect that from our promoters that we partner with, we would do the same we can't deliver magic.
Sure.
These are the skill sets that we bring to the table. These are the people, whether they're in the investing side or the operating side, which will help us to help you get you there. But it's not that we can, we have the wave, the hand of God to suddenly improve your EBITDA from 100 to 500.
I think I love the articulation, and specifically about, it goes back to the intellectual honesty and humility part. Because what you're saying is that even the slightest doubt about one ethical context that you're evaluating the founder in raises many questions about what that founder might do in a lot of other contexts.
Correct.
And so that by itself may not be sufficient to, make you doubt the deal. It's a necessary prerequisite for you to reevaluate the whole relationship and context and situation. Which brings me to Kedaara in particular. Kedaara is a unique company, and what I appreciate most is how you even give every single person carry, which is very unique and sort of rare in the VC PE world as well, for juniors in the firm to also get carry. Could you talk more about how every company that you have evaluated, companies are naturally different and each company has their own unique X factor.
Yeah.
How do you evaluate and judge companies which are unique? And what makes Kedaara and its people and culture unique and special?
Let's go to the latter because that's an easier one to talk about. And we'll move to the earlier part of your question. Kedaara is special. At least for me, it's very special. It's something we gave birth to as a bunch of us who founded the company in 2011, which is almost 14 years ago. And as true McKinsey geeks, we had a base case, a pessimistic case, and a best case or optimistic case. Where we are today is far higher than our optimistic case. And I'm not talking only of the returns, which have been good. I'm not talking about our fundraising, which has been exceptional. As you know, we just closed, maybe you don't know because we haven't publicized it yet. We've just closed our fourth fund, which we raised in a record 3 months.
Yeah.
It was a one and only close, which is unheard of in the industry today. So across performance, across fundraising, I feel we're special. But it goes back to the values, the culture, and the beliefs you put into the organization. Right? And no one taught us this. I think what happened in our case, given you heard what a role that McKinsey played to me, McKinsey played a huge role in many of our backgrounds. So there's a lot of ethos. So the point on carry, I want to clarify, it sounds really good and it's absolutely true. Because very few funds in India or even globally give it to the junior team members on the investing side. In our case, absolutely everyone on the investment side should get it.
Yeah.
But we have extended that to really believe that even our admin team, which is the finance team, our obviously all our operating partners are part of the investment team, so they get it, of course. But our admin team, our back office, even our EAs that you've been in touch with Amanda, you've been in touch with a few others, they get carry. And for us, please understand, it's not that we're giving away all the carry to the youngest people. It's not that. Most of the carry is still kept to the senior guys and the investment team. And a very small amount by percentage is given to the rest of the team. But I'll say the two things. When you have superlative performance, which we have been fortunate to have, even those minor points of carry, in absolute terms, are worth, it's a very large number.
Yeah.
I had someone who used to be, a deputy, almost an office boy being promoted to a junior clerk, come and tell me that there's a mistake, sir, I've got a check, which is more than my annual salary. And I said, even I don't understand what that word carry means. Rishi will explain it to you, which is our CFO. But the important thing was I taught him the concept of don't use it to buy a better car or a motorcycle. Use it for he has a son, use it for your son's education. Right? So I'm saying that ethos of having everyone, and what happens by doing this? You get at the junior levels, they start thinking like owners. So what's the Machiavellian reason for this? They never want to leave. Right? So it's true. You see our guys, if you look at our attrition, which is the biggest issue that most companies are facing now, it's almost zero, right? Because the youngest guys and the admin team, the two things. One is the culture, and when you come by the office, I'll show you the office. We live and breathe that. And I'll get to after carry, there's something called the obligation to dissent, and I'll come to that. But if you look at carry itself, if and only if you do really well, you share that with everyone. It's the only way to do it. So it doesn't feel like it's coming out of you. A senior partner we've just promoted won't ever say, why are you giving carry to the junior people? Because you only get it when you do really well. When his deal does really well is when he'll get a larger proportion. But the youngsters also share in it. So you basically, the belief is, the bigger the pie, the more you can share, right? And that's why the carry, we fundamentally believe, should go to every person in the fund. Secondly, it's the culture you set up, right? And that's critical. One of the basics, and again, I'll be completely honest, we have stolen this from McKinsey. It's a phrase called obligation to dissent. What does that mean for people who don't know McKinsey well? is most people in the investment world, and I'm saying globally, but especially in Asia and in India too, you try to look at your superior and say, what do I do to copy him? Or her, as the case might be. What does that mean? And in IC, when they get promoted, they still have that behavior. They're looking up to someone to drive their decision making. What do we believe? We believe that in a typical team structure, the youngest most member of the team spends the most time on the problem at hand.
Yeah.
He's the one or she's the one going to the field and doing the research. They're getting first-hand information from the company. They're observing stuff. So when you have a team meeting with the junior-most members to the senior-most partners, typically the senior-most guys are pontificating and giving gyan or wisdom. Right? What we believe is the youngest-most people should be talking in that meeting because they have the facts. And what we mean by obligation of dissent is if the youngest or the oldest disagrees with the view of the room or which direction the decision is going towards, not only do they have the right to dissent, that is called the right to dissent, you have the obligation, which means if you do not dissent, we'll penalize you because you've held back the information which could have changed the path of this conversation and this decision.
Yeah.
So if we go the wrong decision based on what the seniors have seen 20 years ago when they were working in McKinsey, I'll give you an example, but don't have a clue on what's going on in the marketplace today with omni-channel sales, how important this thing is, the youngest guy should be correcting our perspective and telling us, you might think so, but you have no clue. You are not the typical buyer when you go to a value store. I mean, you guys are used to your Gucci's and Bulgaris. This is what the common guy in the village wants. And we want this guy to be able to tell us, look us in our face and disagree with, and whether it's right or wrong, it doesn't matter.
It doesn't matter.
But the fact that that individual can state his or her mind is, number one, I think the only way you should invest because then you have a mixture. But more importantly, as a team building, that's the reason people come to us. It's the wealth creation and sharing, then you feel like a partner. It's then being intellectually honest. And then very often we've cut deals because even though we come in with an ingoing hypothesis or a bias, the facts disprove our bias, but the facts are presented by the youngest guys. If you stymie what they're thinking, you're dead. I know a certain global firm which has 3 investment committees. They have an India investment committee, an Asia investment committee, and a global investment committee. I'm not going to name them. I respect them a lot. But on one area they fail is this particular, we were doing a deal with them. The most honest case was presented by the team in the India investment committee.
Okay.
And all the what's of the deal are presented. When that same team presents the Asia committee, it's already gone to the India IC.
Correct.
So then the what's start disappearing. Only the good parts are talked about, right?
Wow.
Then when it goes to the global, everyone's ego now is online. How can the global committee not approve? Oh, if they kill our deal, it's a shame to all of us. So everyone is aligned to make sure they do the investment. It doesn't matter if a new perspective is there, and they don't have the perspective that the junior members have in the team. We have one IC. The IC, the presentation is made by the entire team, the operating team and the investing team. But the junior most member of the IC is told that he has the obligation to say no to his partner, whoever's leading the deal, if he disagrees. And I said, we don't care what happens to this particular deal. But if you held back, positively or negatively, we'll nail you afterwards. And I'm saying nailing you in a matter of speaking.
Yeah, of course.
But what it does, I'll tell you, is the honesty it creates in the room, number one. Number two, you also create a culture where it is truly a servant leader model. I mean, you really feel you're working for the guys because the youngest guy comes in and says, you're wrong. And, so I only joke. I said that the toughest place to work right now is Kedaara because I'm always told I'm always wrong at all times. But on a more this thing, I think the obligation of dissent becomes a part of the culture of the firm where there is a positive and productive pushback.
Yeah.
And I see that really missing in most of the firms, partly because most firms are dominated by a founder or a couple of founders who are seen by the rest of the firm as they can never be wrong. Look at what they've created, they can never be wrong. But the reality is, it's the team which makes the final call, not the founders. The founders have taken risks to set the firm up.
Yeah.
That itself was a huge risk. When you go forward, you've got to have, on different areas, but especially on the investing side, if you have strong sector leads, you have strong MDs driving your deals, you have strong teams working with them to get the deal, your job is to question them.
Yeah.
You should have the obligation to dissent. But it's for them to be really driving the problem solving, the decision making, and then coming forward to an investment committee to be challenged in a productive manner, because everyone's aligned, we want to deploy the capital.
Yeah.
But remember, we only do 4 or 5 deals in a year.
Correct.
We can see 100 deals in a year.
Yeah.
And this, I believe, is the reason, Abhinav, that even a firm like ours, which typically the domestic firms lose talent to the global firms, we've been very fortunate that our last 3 senior hires have been attracted from one, a woman named Sakshi from Goldman Sachs. We've had Ashwat, who's an outstanding investor on the tech side. He's had experience both at Bain Capital and at Apex. We've had other people from other firms. We've got people who've joined us from Temasek, not me, but smarter people than me, a guy called Nishant. So we have been actually attracting talent in the reverse manner than is typically true.
And losing talent.
But I do think, one shouldn't be
Of course.
As the market evolves, the Pan-Asian funds get larger and larger, they need to deploy more in India, their value proposition will also increase. But that's the way.
And how do you evaluate whether a company is unique? You talked about Kedaara, its people and culture.
I think the company doesn't need to be unique. I think a company needs to meet certain parameters.
All right.
Right? If you look at our system, we have a funnel. We have 200 companies that come into the funnel or more than every year.
Yeah.
We finally invest behind 4 or 5.
Yeah.
So the funnel has many. Look at the funnel, sort of shaped like this. 200 come in or more than 200. We have different screens, right? Market attractiveness, capital productivity, growth is an incredibly important aspect. But then, as I said, all those are areas where you can debate around the room.
Yeah.
One which makes us unique in the way we look at the companies is we have zero tolerance internally or externally for unprofessional behavior. I come back to culture and values. If we see something in the company that makes us twinge a little bit, we'd rather let go even after doing months of work so we sleep well at night.
Yeah.
So that's, I think, the differentiator.
Let's also talk a bit about founding Kedaara. You founded Kedaara on 11/11/11, as you say. And there is a lot of founder glorification, but I think that's primarily restricted to tech, largely in popular culture and references that we talk about. Tell me a bit about why you started Kedaara, what it was like, and effectively, it was a startup when you did it more than 14 years ago, about 14 years ago. What was it like?
Firstly, the 11/11/11, it makes a great number. More importantly, the memory stays its course. But I'm not in numerology. I don't believe in, what many people believe in. So it was a coincidence. It was a happy coincidence. I wouldn't change that. I think we registered the LLP of the firm on 11/11/11. We'd obviously started thinking about it a lot earlier than that. I had also left Temasek, if I believe, at the very end of September, actively, though they had me as a senior advisor for a couple of years. But the 11/11/11 was the date that we actually registered the LLP.
Yeah.
Now to your question on why Kedaara. The biggest thing was, I had mentioned earlier about Mr. Bajaj and his constant thing on do your own thing. And I was perfectly comfortable first at McKinsey and then at Temasek. And I said, there's no reason to do anything else. Something started eating me, I would say, after the GFC. The global financial crisis was a big event in most of our lives. For me, in addition to running India, I was also running Global FIG.
Yeah.
So at that time, I had the opportunity to look at many of our global investments when the world was asunder. So you really, in a very compressed amount of time, we started Kedaara India in 2004. It was the first office outside of Singapore. We made an incredible presence felt in India, but I also had a chance to work on some of the largest global deals.
Yeah.
So in a sense, that was done from a the firm had a lot more to do, but at a personal level, I felt what I had managed to do and achieve was phenomenal from an experience perspective. What more was there? At the same time, India was in a very interesting situation where if you look at, there's a plethora of capital, lots of deals happening, but if you see, and lots of private equity firms, but there was very little value addition being done by the private equity firms, number one. Number two, they were normally minority stakes with minimal governance. And thirdly, as a result of the first two, you were leading to a situation where the private equity firm was at the mercy of the promoter. If he did an IPO, you had an exit. Otherwise, there was often no exit.
Yeah.
So there were two other old colleagues of mine from McKinsey who I had been in touch with. They were working with another firm called General Atlantic. And in order to get the skill sets rounded off and a variety of, I'd pull them into the conversation. Three of us spent about a year together talking about these ideas. It helped that Temasek and GA was in the same building at Express Towers. We met quite often in the evenings to discuss what was the opportunity. And there was a huge opportunity in private equity in India. And I think, at least personally, I was ready to make that jump. But as you said, that's a startup. That's the stuff we don't do. If I had gone to a private equity firm for funding to start a private equity firm, I was unfundable. So what did I need? I think the two most important things was clarity of purpose. What were we focusing on?
Yeah.
And then, like every other investment you make, how do I de-risk it? Of course, there was passion. I mean, if it was asked to do that today, I don't know, right?
Yeah.
That time I was early 40s or late 30s or early 40s. The energy levels are still high, but at that time, you believe you could conquer the world. I mean,
That's also the best age to found a company.
I don't know, but people today are founding companies at 20s and 30s. I think the big difference now on that one, Abhinav, is there's no longer a black mark for failure, right? When we were growing up, I'm not sure if we all took the same degrees of risk that the 20 or 30-year-old is taking today. What people are doing today, I think, is magnificent in India because they're taking the risk. Even if they fail, they bounce right back and do something else. And the number of people, even when you graduate from Stanford or Harvard, who will be going and doing startups will be significantly more than they were at my time.
Yeah.
It's not just India. Globally, failure is acceptable as far as you take the messaging and go back into this. So back to your question, what was needed? The idea was there. I said we're going to create a firm which will do both minority and control deals, but it'll be one where we will only take on those deals where we can create value.
Yeah.
So then we needed the operating partners. That was a new model, not yet prevalent in India. So how do we do that was a question mark, and I'll come back to the answer. And then what sort of deals, what sort of sectors, we did a lot of thinking around that. And then most importantly, who's going to give us the money?
Yeah.
So we finally need to be in place. You can have the best academic thinking, but you'll go nowhere. So then we had a two-pronged approach. On what we were going to invest in, we tried to hone in. What we had to realize was what we wouldn't do. And then that's important to get to what you want to do.
Yeah.
Both sectorally and both. I had a lot of background in financial services. As a group, we felt comfortable in financial services, in consumer, in tech and tech services, and healthcare. We also had the beauty of taking an operating partner like a Pramod Bhasin, who knew tech services and BPO better than anybody else in the world. He had started Genpact. So it was the accumulation of skill sets. But then when you thought through it, even though we were a bunch of ex-McKinsey guys who had done investing for 10 years, each saying, we're going to get into controlled investments. That sounds kind of either ballsy, arrogant, or stupid. One of depending on which, as an LP. So what we said is before we launch it ourselves, who are the guys in the world who do this the best?
Yeah.
In my McKinsey years, we had founded the private equity practice. I'd come across a firm called Clayton, Dubilier and Rice.
Yeah.
Clayton, Dubilier Rice is about a 45-year-old firm. It's based in New York. It has an office in London. They probably have the most unique model where they give almost equal emphasis and carry to the operating partners. Who are their operating partners? They had people like Jack Welch.
Wow.
So these were retired CEOs.
Yeah.
So Jack Welch was a fully serving member of Clayton Dubilier as an operating partner. He ran the reviews for every company. But then many others. They had Vindi Banga as an operating partner who ran Unilever. They had the former heads of 3 very senior GE executives. And now they have a plethora of operating partners, almost 30 or 40 in number. And they just raised their fund 12, which is about $26 billion. So for a matter of scale, but at that time in 2011, they were deploying a $4 billion fund.
Sure.
At that time, it looked huge. Today, 26 looks huge. The basis of their playbook was the same. It had been set up in the late 90s. They kept refining it. 2 coincidences. The head was a guy called Don Gogel, who was ex-McKinsey. And more importantly, there was a guy, a very senior partner in the next lung, right under Don. There were 3 or 4 guys in their IC. A guy called David Wasserman. Was led a bunch of sectors, industrials. But more importantly, he was with me at business school. He was a good friend of mine already. So when we reached out more to get, in the Indian terminology, technology transfer, it ended up being a marriage.
Yeah.
So very soon, that initial discussion, which was, how do you do this? How should we do it? How should we make the platform attractive to operating partners? What do we pay them? How do we pay them? What should they be doing? Very clear, they shouldn't be becoming CEOs in your companies.
Yeah.
They should be behaving like the consigliere to the family or the CEO. And in the Indian context, they make them chairman of the companies. Here, if there's a family that we're partnering with, we'd rather have uncle be the chairman and rather don't have a position. So again, the humility factor we talked about earlier. So we combined the best of the CDR approach and Indianized that.
Wow.
We still weren't sure it was going to work or not.
Yeah.
But it was a better way to at least have a partnership with someone that we could learn from, at least the operating partner model. There were many other side benefits. We started replicating their AGMs. We started instead of recreating the wheel each time, how do you write a LP note when you're making a new investment?
Yeah.
Do you use leverage for your... So it was they didn't know India at all, and that was not what they came in for. But they were very gracious in their know-how and technology.
Yeah.
And that I believed, even though our need for them is significantly lower right now, at that time, even for stuff that I don't even realize today, they probably helped us de-risk the firm significantly, especially in the early years. So to me, that partnership, so anything we did was to de-risk the firm. And then the final thing was we went on to a bunch of domestic families who knew us well, who knew me well, knew our past history. And we raised a small amount of capital for Fund 1. But that was the first round of capital. These are names that you will recognize, but we'd rather keep them private. There were about 7 families that supported us, again as investors in the fund. And then we went out to our global investors. And it was... I just told you we finished our last fundraise in 3 weeks, and the number's north of 1.5 billion.
Yeah.
This one, to get to 500 million, took us almost 2 years.
Wow.
So this is when you had the mindset of beg, borrow, steal. No, we never stole, but we were begging and borrowing. We were begging at least, right? And we went to all the global guys. We went to a lot of family offices. We went to a lot of global pension funds. And we had a trickling of money coming in initially, because there was some degree of doubt on India. There was some skepticism on the team, you guys all know each other well, but you've never worked together.
Yeah.
How will that be? There was skepticism on India in 2011. So all those things, but we managed to scrape through a total tidy sum about $570 million for Fund 1. And we started deploying that.
Wow. That's been quite a journey and quite the background. Thank you for sharing all this context about CDR. I don't think I've come across that before in any of your previous conversations or interviews or even speeches, and that's something that's very unique. To replicate that, Indianize it, and then sort of go at it. That's something that I find quite incredible. I want to talk about conviction. You mentioned that you have about 200 deals coming to you every year, and you only make just 5 to 7 investments, and that's an abnormally low number. What that requires is the ability to say no to a lot of things and to be very right about just a few. And dare I say, it's your job to be right when you're in such a difficult sort of business climate. How do you develop conviction, and what are the ingredients or lessons that you've learned about developing it so far?
No, I think when you're entering a new company, it's the usual, right? It's not that a deal comes to you and it lands on your table.
Yeah.
I think the very first thing you do up front is be humble and first say, what do you not know anything about? And you keep that playbook out. So, for example, we don't touch anything which is anything which requires government approvals or is highly regulated, or real estate driven, where there could be other sources of capital, black money, etc. involved. And again, we're not trying to be purer than thou. We just say we have no competitive advantage compared to the players who play in the infrastructure, oil and gas, real estate space.
Yeah.
I would not want to be competing in the value chain of any of the large 2 Indian business houses, with all humility, right? So why should I? Then it really boils down to, once we understand, let's say, a couple of sectors that we believe we know probably more than anyone else on financial services and consumer. So almost every deal in that space comes to us because of our reputation, which took time to build up, or because we are beating the pavement. We're not waiting for the banker to show us a certain deal. We have mapped internally every company from top to bottom in that space. In that mapping, we already know the 70% that we would not be able to do a deal with. Maybe they're too large, they're listed and too large. There's some issues that are known about the promoter. We don't want to go there. There's no Kedaara angle. We'll leave that. So we only focus proactively, and we go out and make the first meeting as often as a banker shows us a certain deal. Because we should know that company better than most. And we help the other guy do. The tougher part really is having conviction to sell. So there, I think.
When to exit.
To exit. Because remember, when you're having a conviction to enter, either it's a proprietary deal that you're discussing, and the question should be asked of the promoter, why are you going to the Kedaara and not to somebody else? Right? Or it's competitive. So there is a Kedaara angle to it. But when you're selling, it's even tougher to a certain extent, because you've got to have the conviction you're maximizing and optimizing both your returns, but most importantly, the returns for who you're holding it in a fiduciary responsibility, which are my limited partners. My limited partners should be happy with my returns and with the cash flow they get back. And remember, if I am a seller, someone's a buyer. Why is that guy buying it? What does he see in the company? That should make me not sleep at night, right? But I'll tell you, having done this now for more than 25 years, there is no one price for everyone, right? There's also the view of a financial sponsor or a strategic, right? The value that I have for a certain company, if it's 100, I think this is the value I can bring it up to. This is the EBITDA that I can underwrite, given the growth. This is how much Let's take 2 different examples. There are lots of deals happening now from PE to PE, right? So another financial sponsor may have a very different view of the same company. He may say, I can drive performance even larger because I know A, B, and C, or I have operating partners C that you don't have, Kedaara. And we have access to these 7 portfolio companies in the US, let's say it's a BPO company, that we can provide more business that you can't. Or we have M&A opportunity with one of our existing portfolio companies that you don't have the opportunity. So we can pay more for something that we believe is worth X. So whenever it exceeds our expectation of fair price, and a minimal threshold, we would happily sell and get the liquidity. For a strategic, the reasons might even be stronger.
Correct.
The strategic could have synergy, value, savings, other areas of operational synergy, cost-cutting synergy, which we didn't have. So again, they can pay a higher value for the same company. And finally, remember, Abhinav, as you will get a lot more in the next 2 years, is the underlying cost of capital. There's no one single cost of capital.
Yeah.
My cost of capital versus that of another PE firm might be quite similar, but that compared to a global pension fund might be very different. A global pension fund might be happier or satisfied with a lower rate of return for a similar risk. Likewise, a family office. So the ability to pay different prices depends both on the value that a buyer can put into the company, the synergies that could exist with existing portfolio companies, or just the underlying capital, the cap rate can differ from investor to investor.
That's a very full answer. We've talked a lot about investing and money and assessing people and building Kedaara and building this incredible culture. I also want to talk a bit about having the good life. What I mean by that is that I read this post by Morgan Housel, the author of Psychology of Money. It's titled Very Important and Hard to Teach. And I think one of the things that I am curious about is how do you, from that PE investor lens, look at building the good life, right? He raises these 3 important questions. That the 3 most important things that will determine the arc of your life are whether you marry, whom you marry, and whether you have kids. And I think, a lot of what goes into making the ideal life is not quite discovered yet. And from a value accretive, value generative angle, from a wholesome, holistic angle, how would you think about building the perfect life and what constitutes that?
Wow. We have another 2 days. No, I would say let's get to your specifics first, and I'll get to myself a bit later. I think the single most important things, and I'll relate it also to what we do, is about setting the right atmosphere, the right frameworks. And this is not only in your married life, but also with your kids. Right? I have 2 boys, one who's 22 and is at Columbia right now, who's a junior, younger one, full of musty, who's all of 14. What you've got to prepare them for is life is full of ups and downs, right? You may be in a high right now, you may be in a low right now. But think of life as a journey that you'll have some very happy times, you'll have some very challenging times. Your approach should be even keel, right? Not let the excesses spoil you, and not let the depressions put you into a depression. What does that mean? Remember that you probably won't be allowed, if our kids live to, let's say, 100, which is now a realistic expectation given improvements in medical technology, you probably won't be around for more than 50% of their lives. Right? So a good 60% of their lives are going to live without your influence, or without, as they would tell you now, without your constant bickering. So on a serious note, what's critical for them is to develop their sense of right and wrong, the values and the culture that you develop even at home, whether it's honesty. We've had a family member in the extended family who's had an oncology issue. On day 1, we were completely honest with both the children. They know exactly as much as anybody else knows. The value of caring, the value of saving, humility. So actually what you do in the investment world is not very different than what you do in your personal life. It's even if you can afford a very fancy place or a very fancy car, do you need it? So you've got to, and in people like us where we have over time, we're lucky enough to be a little bit more privileged, always remember how everybody else. So in my mind, for kids to develop their own value system, to tell what's right and wrong, to really believe what their own. I have no perspective. I may have a view. I don't think I can ever tell my two sons on what they would be doing professionally 10 or 15 years. Today, they have to follow their own passion. They will find what the right path for themselves is. You can just put on some of the guardrails earlier. Where do the guardrails say, what should you not cross over into? Very few things. It could be drugs, it could be excessive alcoholism, it could be something is not being mean to other people. And actually, I'll also tell you this, the criticality of that children growing up and the value system they espouse, we often don't make a final decision on an investment until we've had a chance to see the promoter in his office. How he behaves and treats the rest of his team is important. To the levels where we can. I also want to have a dinner at his house or her house. To me, the best indicator of success, or a good indicator of success, is how well brought up the children are.
Interesting.
If it's a spoiled brat wanting the moon, not bad completely, it happens. Understanding why it happens. Right? I can give you, without giving names, a string of entrepreneurs we have in India who we admire. We put on the pedestal. I'd say 80% of them, similar traits for the kids. Remember the kids, most entrepreneurs and promoters are first or second gen. Their upbringing, including mine, was a very tough upbringing. You had some wealth, but not the immense wealth people are used to, or the access. Our kids, and most promoters' kids, have been born a bit more with a silver spoon. You've got to make sure their hunger and their passion remains like one without the silver spoon, and their behavior towards others is example. So just to finish on the thought, amongst the largest promoters in our country, I would say, having known most of their kids well, 80% of them have kids that I would admire on how well they're brought up. But there's 20%. And I will tell you, that has had a real impact on how I invest. I'm saying if your family is the single most important thing to you, if you haven't taken care of that, how will you take care of your business?
That's
something to ponder over. Again,
very interesting thought.
What you see is the office.
Yeah.
But to me, and that's where you'll see, and I don't talk about this often outside, but I'm often seeing in almost forcing myself with friends and with our company promoters on spending time with the kids and the guys, which I really do enjoy. Should they be going to the United World College or not? If they go to university at a graduate, where should they be going? It gives me a chance to look at the kids. There's no right or wrong.
Of course.
But how do they think about it?
It's a good proxy.
It's a good proxy. Or when it comes to business school, are you going to make a decision to go to the West Coast or East Coast? Could you even get into the East Coast or West Coast, right? So I'm making light of a very serious point. To me, the family fabric is by far the single most important. But I think one needs to balance it with the self. In my case, to live a full life, increasingly I'm realizing I need more time to me. It's not about selfishness. It's time to reflect. It's time to think through different issues. So there's something called, I don't think it's after a certain age, maybe I did it a bit later. Make sure you have enough time for yourself. Identify what are the sources of oxygen to your own body. And when I say oxygen, that's a proxy for habits, interests, passions. Make sure you realize what they are. And as soon as you have time, and hopefully you do you may not have time for that when you're starting off a new career, when you're starting off a new profession. And hopefully you should do it even then. I didn't have the time. Today, when there's a little bit more time to reflect, it makes you a stronger human being. It makes you as a much better investor. So my 2 words to myself is be honest to myself, most important. Secondly, make sure that the flows of oxygen, whatever that might mean to the individual, continue. And then the broader one to the full life, to be the children and the family, including the spouse, that's the nuclear family and the extended family is trust and honesty. And then the similar words of culture, what should they be doing? Humility are critical.
Love it. We've talked so much about so many things, and I loved how contextually relevant each of your answers have been, particularly this one, in which family is a good proxy for understanding what the motivations and how the other person really is. Now, I want to end on one note, which is really about value creation. Ultimately, we're all in the business of value creation. As an investor, as a value creator, as somebody who's been at this for more than 2 decades, I'd love to understand from you the 1 or 2 or 3 skills, thoughts, ideas, tendencies that are perennial, everlasting, and that will tide everybody through whatever they're doing.
No, I think this is very thoughtful, Abhinav. I think get the context first. At the end of the day, we actually have a relatively simple life
Yeah.
in private equity. We do 4, 5, or 6 deals a year. We get more than 200 deals that we can evaluate. When you look at your personal life, I have 2 kids. I have interest in maybe 10 or 15 more, but the one who are on mine are 2. Right? The most important aspect to understand is what you don't know, right? And recognize what you don't know and what you can't do. So it makes life a lot simpler. I keep saying, let's take work. We have 100 units of options.
Yeah.
By knowing, as I said, I don't do real estate, infrastructure, anything in the values. I go from 100 to 40. I don't need to care about the 60 suddenly, right?
Yeah.
The stuff that I know that I don't have a competitive advantage, I don't even want to spend my time thinking about it. It's nice to know there's a lovely new Trans-Harbour Expressway opened, but who built it, how they built it, how they make money out of it, I don't want to know. Right? So then that 30 to 40%, you've got to then over time realize, what are you really good at?
Yeah.
It could be sectors, it could be themes. For us today, I don't think anyone can do consumer or financial services deals as well as we can. We have a certain ethos, an understanding, a different take, a value addition, a Kedaara angle. We also do healthcare and tech services, where we're also developing a value proposition. So not knowing what to do versus knowing what to focus on is, to me, if you're going, there are so many players and so many options out there. Unless you're true to yourself on what you don't know,
Yeah.
you'll never have the ability to focus on what you do know, right?
Yeah.
So that to me is by far the single most important aspect of it. It then goes down to what you know really well. Make sure you invest behind the skill sets, the reputation, or whatever else you need to make sure you're called on the table and you win that deal. And then when you win the deal, you deliver against what you deliver from. And the deliver against the last point is the point I go back to: honesty and transparency. Whether it's your portfolio company who you're trying to attract, we're known to be very honest about what value we can bring, what resources we can put against, and we are known to put more resources than any other firm on the street in terms of adding value.
Yeah.
But we'll also be the first ones to say, if that's a regulatory angle which needs work with the Delhi, we're the absolutely wrong people. We're naive on that front. We wouldn't know how to do it. If that's the value addition looking for us, we're the wrong guys, go to somebody else. We'll actually tell someone, after spending time, we may not be the best capital for
Wow.
you. You may be better off with X, Y. At the end of the day, this will always come back to either haunt you if you do it badly or to reward you.
Yeah.
So in my mind, and the same thing with our investors. Simple statement: share bad news first. We have lots of good news. We have lots of deals. We've done a lot of deals. We deploy capital. We return capital. But when your investors trust you is when you don't put stuff under the carpet. The stuff that is bad news, you announce first. You call them up. You send them an email. You say, guys, we've got to share this with you.
Yeah.
And that's what it is. So to me, it's all about not inflating your ego and say you can do everything to everyone. It's being recognizing your underbelly, your weaknesses, and not spend time on that. Really focus on strengthening what you think are your strengths and developing the skill set personally, individually, as a team, hiring the right people to make sure you do that. And then being honest and transparent to both investors and your promoter companies and staying the whole cost. And you know what? Everything is not going to be a success.
Yeah.
We have been very fortunate. Out of 30 companies, 29 companies in our portfolio, we've only had one that we've marked below cost. That's not the average. But the reason we've got there, I believe, is because we know what we don't know. We know what to focus on. We'll still make a few mistakes, and that's life. Out of the 29 firms, we've invested capital out of Fund 1, 2, and 3, and we've just raised Fund 4. We've only marked one lower than our entry price. We're putting our full resources behind it.
Yeah.
Hopefully it'll recover, but that's mine. So I'm saying the reason we've got that is because we've always never underestimated how difficult it is to get a deal done. Been humble to recognize what we don't know and what sectors we won't add value, and redoubled our efforts to hire the right talent, operating and investing, to focus on what we know, and then single most importantly, being very transparent very early to everyone we work with to give the bad news, and then eventually to share the good news. So all I'm saying is, after you've gotten to a certain, then life is not that difficult anymore.
Yes.
Because you've created a reputation. You're out hunting for deal. Your entire team is hunting for deals. Deals come to you. There is a word of mouth impact. It was much tougher 14 years ago.
Yeah.
It was difficult to create, but luckily going in, there was an existing reputation.
Yeah.
The good thing in the last 14 years is, after doing good and being transparent and honest, that reputation is increased, which is why life has become a lot easier now. And hopefully we'll get more time with the children.
Manish, this has been a pleasure. Thank you so much for joining me today.
Thank you, Abhinav. Pleasure being here. And now I'm going to visit you in either Stanford or in Boston.